All right, here we go with the fun stuff. We just talked about what a T account was. Now let's talk about the T account rules. Like I said, debits was left, credits was right. But each individual type of T-table or type of account, they're going to mean something different. So that's what we're about to talk about. Bear with me because this is going to get it can get a little bit tricky. But let's start with the first one. Let's start with assets. Okay, here's an example of our asset account T-table. Again, debits on the left, credits on the right. But when you're dealing with assets, the debit means plus and the credit means minus. So anytime that your asset balance goes up, let's just use cash for an example. Anytime your cash goes up, you're going to put that amount on the debit side because it's on the plus side. Anytime that you pay out cash or your cash goes down, you're going to put that on the credit side because the credit is negative. Okay, and that's for all asset accounts. That doesn't matter if it's cash, accounts receivable, inventory, supply, whatever. They all follow that same rule: debit plus, credit minus. Okay, let's look at the next one. We'll go to liabilities. Again, debit still on the left, credit still on the right. But with a liability account, remember any payables or unearned revenues, the debit is going to be negative and the credit is going to be positive. So it's completely reversed from what it was for assets. So again, if I go buy something on account, which means that my payables balance goes up, I'll put that on the credit side. If I pay off a balance, let's say I have a credit card, if I pay off the credit card, then I'm going to put that amount on the debit side because I'm lowering my balance. That's liabilities. Now let's look at equity. Equity again, debit's left, credit's right. This is going to fall in line with liabilities. This is going to be minus plus. Minus is a debit, credit is a plus. Okay. Now we can also break equity down into three pieces. We should know these because they're three things that affect retained earnings. We have revenue. Again, debit left, credit right. Revenue is going to be minus plus as well. So again, anytime I earn revenue, it goes on the credit side. Anytime I have to take away revenue, it's going to go on the debit side. Expenses are going to be plus minus. Debit is plus, credit is minus. Anytime I go and purchase something, I use something, that amount that I'm going to expense is going to go on the debit side. Anytime I don't, or I lower my expense, it's going to go on the credit side. And dividend, which is very similar to expenses, it's just we didn't use them. It's just we used money, but that's about it. It's going to be the same as expenses. It's going to be plus minus. So the best way I remembered how to do this was the acronym ADE. ADE. Assets, dividends, and expenses. Those are the only three that are plus minus. Everything else is minus plus. And so if you need something, and it's training yourself. There is logic to it, and you'll find that out a little bit later. But this is just one of those things that's just easier just to get to know and get the practice of. So that's your T-table or T account rules. Appreciate it.